basically using open invoices. So this is really one of my favorite ways to be able to get money to grow a business for a lot of different reasons you're going to find out today, including the fact that it's not based on personal credit. It's not based on you having cash flow or other kind of assets as collateral. The rates are ridiculously low. And this kind of gives you dual benefits. You're able to let your customers pay on terms and then use that as an asset to be able to qualify for really easy to qualify for low rate financing. A lot of cool things with this program. And today I'm going to teach you what it is, how it works, how to get approved, and a lot of different ways you can tap into customer payments and use those to be able to qualify for financing. So let's get started. So did you even know that this was an option, that you can use open invoices to access cash for your business? Well, this can be really helpful when customers are slow paying, and it's also not uncommon that it leaves you cash blind, where customers are supposed to pay you on a regular basis. They don't pay you on a regular basis, or you're letting customers pay you over a longer period of time, delaying when that money comes in the door. A lot of problems when you let your customers finance through you. And today we're going to basically come in and talk about how to take that problem and turn that into a huge asset for your business. So basically, invoice financing is when you're using open invoices to get funding, and it's called invoice financing. Sometimes it's called invoice factoring. Sometimes it's called AR factoring. Goes by a lot of different names depending on how you use it. But there's a lot of different ways you can tap into letting your customers pay you on terms and then use that to actually qualify to get money for your business. So basically with this, you're using your open invoices to be able to qualify for funding. Now it can be a one-time event or used as an ongoing basis. So what I mean by that is that, let's say, and I'll give you an example here, at Credit Suite, when clients enroll with us, we can finance their enrollment for them and we can let them pay over 7, 8, 9 months. So that means that we actually have what's called account receivables. People are paying us on terms. Well, that actually comes in and that gives us the ability to be able to have those open invoices or people paying us on terms. And it allows us the ability to be able to use that as an asset to be able to qualify for financing. Now, there's a couple things we could do here. We could do this just at one time. So we really need money. We've got a lot of clients that owe us money and pay us on terms. We could tap into that to get a big chunk or cash injection into the business. The second thing we could do is we could do this ongoing, meaning instead of letting customers come in and pay us on terms, we could actually come in and wait to get our money 7, 8, 9 months. We could get the majority of our money right away with this kind of financing as well, without having to let them pay us or to collect our money in time. So to kind of go through that, imagine a lender that let our customers take 7 months to pay us, but then they give us most of that money right away. That's just one option of how invoice financing can work. And by the way, if you're just coming in, give me a shout out. Tell me where you're coming in from. Always love to tell you hello. Okay, so that being said, why this is awesome? Well, first of all, secured financing has a lot of requirements are reduced from normal financing. What I mean by secured is this. There's two types of financing. There's unsecured and there's secured. Unsecured is like not secured by anything. So there's no collateral that's being pledged as collateral for the debt, or no asset being pledged as collateral for the debt. So an example here is a credit card. When you go to get a Visa card or a MasterCard, you're not pledging anything as collateral to get that credit card. It's unsecured. But if you get with secured financing, it's secured by something, meaning the lender can take something back if you default. In this case, it's your customer's payment. Your customers are paying you on times. That's the security. Now, what's nice about this is whenever you deal with secured-based financing, any kind of financing that's based on you pledging an asset as collateral, it's way easier to qualify for. It just is. You can get it with bad credit. As a matter of fact, with a lot of financing sources here, they don't even care about what your credit looks like. They don't even do credit checks. So no matter how bad your credit may be, you're still able to qualify. The other thing is you don't need anything else as an asset that could serve up as collateral. You can get this as a newer business. You don't need to have good credit. You don't need to have cash flow. You're not going to verify tax returns or bank statements, any of that stuff. All you need to have is customers paying you on terms. And if you have that, well, that's the basis of being able to qualify. So for example, cash flow financing is determined based on, your customers paying you and regular money coming into your bank account as well. So there's a lot of other funding that really taps in to this kind of financing as well, meaning by letting your customers pay you on terms, that opens up the door for you to be able to get a lot of other kind of financing as well. And you can also collect on invoices that are past due. As a matter of fact, today I'm going to show you how the lender can even do that collection work for you. So the nice thing is that with this kind of financing, you can even go with funding sources where the lender is the one responsible for getting the customer's payment. So if the customer ever does slow pay or they default, well, then it's the funding source's responsibility to follow up with that customer and get payment in the door. One of the biggest customers for this kind of financing is Johnson and Johnson. So you can think about how big Johnson and Johnson is. I'd have to do a Google search, but they're huge. So Johnson and Johnson is one of those that comes in and does AR financing, and somebody else collects on that money for them. Other good examples are people in the medical industry. So, if you're a doctor's office and you're working with Medicare, Medicaid, and insurance companies, that takes a full-time person just to try to collect from those companies. But a lot of them get this kind of financing because they don't have to worry about it. An outside source is doing the collecting for them. An outside source is working with Medicare, Medicaid, and health insurance companies to get payment in the door. So huge benefit when you might not even have to be the one that's worried about getting payment in the door. And the other thing is you can get your money a lot faster. So basically, you don't have to wait for them to pay you over many months. You can actually get the majority of your money very quickly. As a matter of fact, once you're approved for this kind of financing, future invoices you can get funded within 24 hours. So I let a customer pay me over 7 months, and yet I get most of my money the next day. So there's just a ton of benefits here, but these are some of the main benefits of why you might like invoice factoring. Now, what does this look like? Well, some companies will have you submit open invoices then to secure a line of credit equal to the total of the invoice less a premium. So typically what happens is, let's say we let our customers pay us on terms, and let's say that we have $100,000 in money that's owed to us over 7, 8, 9 months. Well, what a lot of these funding sources will let you do is they then give you a line of credit or loan against that outstanding money, and they deposit the majority of the money instead of waiting the next day. So a simple example is they go up to 90% financing with this kind of program. So let's say I have $100,000 worth of invoices. Those invoices get paid every month over 7 months. Well, instead of waiting 7 months to get paid, the funding source will then give me 90% of that money. In this example, $90,000 the next day. And then the remaining $10,000 they pay once the customers have paid all those payments minus their fee. So again, I let my customers pay me on terms. I get up to 90% of my money deposited in my bank account the next day. And the nice thing is my customers still get the ability to pay on terms. I get the majority of my money right away. Then I get the remainder of that money minus the funding source's fees at the end once the customer's paid everything. So pretty cool way to do it. In Baltimore, Maryland is in the house. Thanks for giving me a shout out. And again, if you're just coming in, tell me where you're coming in from. Always like to say hello. And Brilliant Davis is here from Unbound Business Solutions, LLC out of Tucson, Arizona is in the house as well. Well, I think it's Aiken, South Carolina is in the house too. First time I've seen Aiken in the house today. So thank you very much for coming in and saying hello. And if you get just coming in, tell me where you're shouting at, where you're coming in from. Always like to hear. So payments are made when the invoices are actually then paid. The final payment is made. Okay, so there are two options to collect on the invoices. Either the lender assumes the collection responsibilities or you still collect to pay the lender. So some of the funding sources will still let you be the one that pays or collects from the customer. And I'll tell you, this is mind-blowing to me. I still talk to a lot of entrepreneurs that insist they want to be the one that talks to the customer to collect payment. But the biggest companies in this country that use this, they're the ones letting the funding source collect the payment for them. It's one less headache that they actually have to worry about. So we actually have a company that helps finance a lot of our clients for us. And we absolutely love it for all the reasons I'm telling you here today. We can let our customers pay over a year. Think about this. So we can take what we charge and our customers can finance it over a year. So our customers love it because they can enroll, have us help business credit building and financing and getting their fundability in line. But it only costs them $200, $250 a month because they're financing it over the course of a year. So huge benefit for the customer. The longer payment terms makes it affordable for them to be able to enroll comfortably because it only takes $250 from them a month. But again, we like that because the nice thing is we get 90% of that money advances, or actually almost all the money advanced to us the next day. So we benefit and the customer benefits as well. And most of our customers pay as agreed. But it was interesting because I was talking to our sales manager. We were at a conference in Las Vegas speaking this weekend. And he said, yeah, for the first time, of that from us sending customers over to the funding source, I see 2 people are currently behind. They're late on their payments. And the nice thing about that is that usually in our world, we'd have to have our billing team call to collect payments to hunt those people down. We don't have to do that. So we don't have to chase them. Now the funding source is chasing them to get payment. We're not. So it just frees up a lot of bandwidth so our team can focus on other things instead of that. Now, any business that has open invoices can typically qualify. There are no industry restrictions. So again, even if you're seen as a high risk industry, you're still able to get really low rate financing with this because there's no industry restrictions. All you need is customers that pay you and pay you on a regular basis. And by the way, the customers that pay you and pay you on a regular basis, almost all of these sources, those customers need to be other businesses or the government. They really want to do AR, receivable financing, invoice factoring from people that are either businesses or the government because those are more likely to pay you. The other thing is, although they don't care about your credit, they are going to look at the credit of the companies that are paying you. They want to make sure that the companies that are paying you are reputable. If the companies that are paying you have bad history of not paying their debt, well, then they may exclude that invoice. So let's say I send them over 100 customers that are paying. The funding source may say, look, we're going to finance all of these except for these two. These two we won't finance for you. And the reason for that is because those two they won't finance have a bad reputation in not paying their bills on time. So again, the nice thing is they're even kind of doing a business credit check for you and telling you people that are going to be more problematic and probably won't pay you as they're supposed to pay you. Okay. And it also is a great option to collect on past due invoices as well, or aging invoices. Okay. So it's a great option for getting paid on invoices that are past due. Now, again, if you take invoices you already have that are past due and you move it to a funding source, they're going to probably charge you more money on those because they already know they're in a situation where they're going to have to collect. And again, they're going to probably want to take over that collection process. But this is a really good way to go as well. So if you really need a cash injection of money or you want a cash injection of money, you can come in, take your aged invoices, the invoices that you've already had outstanding, move those to a funding source. And if you hand over the collection responsibility, they'll even go after the people that are currently behind and still fund you on those people that are currently behind. So a great way to do it with new customers that pay you moving forward, and a great way to be able to go backwards as well and be able to get paid on those. And Daniel Claybrook, you're in Wesley Chapel, Florida. I'm gonna tell you, man, I had a house up in Trinity right by you. I spent a lot of time in Wesley Chapel, and I'm right here in Tampa, so we're like neighbors. Curtis from Chicago is in the house. We've got Phoenix in the house as well. Thanks for coming in, Poet Woods, and saying hello. And the corporate builders in the house, and the ghetto Shark Tank is in the house as well. I love that. That's awesome. Thanks everybody for coming in. Tell me where you're coming in from. I always like to give you a shout out, say hello. So easy qualification process. With this, all you need, and you need proof or what's called an aged AR list that shows the consistent pay history from those clients. So an aged AR list just kind of shows how those customers are paying over time. It shows the status of those account receivables. And by the way, if you don't, you should have some kind of system to be able to manage AR. Most people that are letting their customers pay on term use some kind of software to manage that. It's very cheap and easy. There's a lot of options there because they're going to want those two things. They're going to want to know that you have open invoices and then you have some kind of log, some kind of tracking, some kind of software that shows the payment of those invoices so they can get an idea of who's paying you and who's paying over what term and how they're actually paying. Now, again, lenders are not looking at the creditworthiness of your business, and they're not looking at your business credit. They're not looking at your consumer credit as well. If anything, they look at the credit of the company paying you, but they're mostly concerned with the company's reputation itself that's paying you and the payment history of that company to you. You don't pay any interest on this. Instead, you're paid less the invoice amount. So typically you get 80 to 90% minus their fee, and then they're actually not keeping usually 20%. They're actually just keeping that for a short period of time till they collect all the invoices and then they pay you. So how much do they actually charge you on this? Well, there's called factoring rate, and factoring rates are as low as 1 to 2%. So factor rates can be as low as 1 or 2% is what you're actually paying. And that, of course, adds up and builds up the longer the invoice is outstanding. So you're going to collect more money and pay less of a fee if the customer is paying you over 30 days than if they're paying you over 7 months. So the factoring rates are usually as low as 1.1, 1.5%. And the factoring rate's based on how long the invoice is outstanding, how long the customer has to pay you back. The longer they have to pay you back, the higher the fee of the lender goes. But again, really nice on regular terms that most people charge 3-6%. You could pay significantly less on this than you would any other kind of financing. And what I like about this, by the way, is that this allows your customers oftentimes to use this kind of option and pay less than they would pay if they even paid you with a credit card. So instead of them paying a credit card and paying a 10, 12, 15% interest rate, they can come in and do this kind of financing. You could basically extend terms for them. The funding source finances it, and it's way cheaper and less or more affordable than if the customer even typically uses a credit card to buy. Now, again, they don't really look at your personal credit scores. That's not an issue. They're really concerned at all, if anything, with the credit of the business that's paying you. And you can also do this very quickly. It usually takes about 3 weeks to get initially approved. Once you're approved with a finance source, they'll typically finance your future invoices in as little as 24 hours. Now, minimum docs, all you have to do is provide that aged AR account so they can see who's paying you and how those people are actually paying. And then they're also going to sometimes want to see that money going into your bank account. Sometimes they look at bank account statements. Sometimes but most of the time they don't. Most of the time, all you need is an application and an aged AR report, and you're able to actually get approved. So if you have an AR report, if you have an application, you're good. Sometimes they may ask for a debt schedule. Sometimes they may ask for bank statements to see the money going in your bank account, but they're usually not going to if you have a good aged AR report, which is why I'm saying you should use some kind of software to track your account receivables. If you do that, it's way easier to qualify for this kind of financing. So again, the nice thing is that you can offer terms to your clients and encourage them to do business with you because they can pay you over time. And by the way, if you have a product or service that warrants it, you could charge a lot more money. So you could charge a lot more money and charge what your product or service is really worth. And then again, let a customer pay over time, which still makes it affordable for them as well. By the way, I have found in over a decade of doing this that if you have a really good product or service, most people aren't going to question the price if you've got a reasonable price on it. They just want you to, they're just concerned about affordability. And I found this in 2 decades of financial services. I've sold a lot of stuff. I've been in auto financing. I've been in mortgages. I've done a lot in the business space. And no matter what kind of financing I've worked with, what I've always found is that clients will, if they want it, will typically get it if they can afford to buy it. And so what's nice here is that the client's getting better terms. And again, they're able to afford it. So you're able to sell more of your products or services, but you're still able to get a lot of your money quickly. So I think that's a huge benefit as well. And Reginald says, how can I get credit or how can I get financing for my tire shop? Well, again, there's a lot of different ways you can get credit for your tire shop, but let's just talk about general funding. So if you're talking about a funding shop, Reginald, all you'd really have to do is tap into whatever your strengths are. If you have consistent revenue, that opens up opportunities like cash flow financing, merchant cash advances, term loans. If you want business credit, well, then you want to talk about building business credit for your EIN that's not linked to you personally. You can give us a call for a free finance assessment. We can get your business credit reports, give you tips and tactics on that as well. There's even programs where you can use good personal credit to qualify, like credit line hybrid. So any of those are good funding options for you, even grants. If you'd like to learn exactly the best option for you, give us a call. Free finance assessment. We'll tell you all the lending you can qualify for now. We'll give you tips and tactics to build your business credit and even do a check of what lenders look at to determine your credibility, and we'll help you make some changes there to have a better chance of getting approved for more money. So what if you don't have other kind of financing? Well, then you might want to look at things like merchant cash advances, for example. You might want to look at cash flow financing. You might want to look at business credit. A lot of those different options that can actually help you as well. And all you have to do is just give us a call. What we do on a finance assessment is 3 things. The first thing we do is we work with what's called fundability. Most people are denied for loans, denied for credit lines, denied for business credit cards, not because you don't qualify, but because you just don't meet basic lending standards that lenders and credit issuers have. This is called fundability. So the first thing we do is just to check on your fundability, tell you what to fix, tweak, and improve. That radically, exponentially increases your chances of getting approved for credit financing. Then if you have business credit reports, we get them for you at no cost with bids with Dun & Bradstreet, Equifax, Experian. We go over those with you. We give you tips and tactics to build your business credit. Even if you don't have business credit established, we still tell you and walk you through the steps you need to succeed there. And we also do a funding qualification. That way you never need to look for funding again. Well, all you have to do is give us a call and we'll talk to you about all the financing that you can qualify for right now as well. So to recap, you can use existing customers' payments or invoices for you to basically be able to fund your business. You're able to get as much as 90% of what the actual invoice is paid to you within 24 hours. You get the rest once the customer pays the whole invoice. You don't even have to collect on customers' payments or invoices anymore. The factoring rate's as low as 1.2, 1.3%. So very cheap money, not based on consumer credit quality, not based on you having any other kind of asset other than the account receivable. And also at the same time, again, it's not based on cash flow. So you don't really need bank statements or tax returns or to verify your revenue as well. If you got value from this training, check out creditsuite.com/toolbox. At creditsuite.com/toolbox, you get about $300 worth of free tools just because you share our next live stream. And all the details are right there at creditsuite.com/toolbox. Also, don't forget to give us a call for your free finance assessment, and make sure you click on the link on our top of our page, creditsuite.com. It takes 1 minute. And then in 1 minute time, you can like and subscribe to our social channels. We have daily tips on places like Instagram and Twitter and Facebook. We've got thousands of videos on YouTube that can help you, a podcast you can listen to on the go, and you can access all of those at the top right of our page, creditsuite.com. Now, Traders Life says, hey, Ty, I have a question. Can I finance a vehicle for my business through Credit Key? Well, yeah, you can. So first of all, if you're going to finance a vehicle for your business, you're better off to go and build your business credit and get auto financing that way. And the reason for that is there's no recourse. There's no personal guarantee. There's no personal credit check. You need about 14 accounts across all 3 of your business credit reports with DNB, Equifax, Experian, and you can get auto financing without a personal guarantee and credit check linked to your EIN, not you personally. That's the best way to get auto financing. Now, you can go into any dealership with a guarantee, and they can also put the financing in your business name. So that's another option. And then you could use a credit line to a place like Credit Key, depending on the source. So you have to talk to them, meaning they'll give you a credit line to buy other people's products or services, depending on the reputation of the source you're buying from. As of vehicles, you'd have to go to them direct. And with that, you'd have to actually come in and tell them the source that you're looking to get the financing through, and they could tell you whether or not you can be approved or not. But again, build your business credit, get auto financing. In my experience, is the best way to do what you're describing. Okay, so hopefully that helps you there. Brilliant Davis says, thanks, Ty, for all your mentoring and your free teaching and information, and give you truly appreciate it. You have 100% been helping me grow and scale my business. I love having you here. Brilliant Davis is here a lot. Brilliant Davis, thanks for coming in. I really appreciate you coming in and sharing your feedback. And again, it's awesome to have you. So thanks for coming in. Thanks for being a powerful way to make it easy for your customers to pay and for you to be able to get really cheap financing really quick and easy, and make it easier to get more customers while still getting the majority of that money right away. If you want to talk about more ways you can qualify for financing, give us a call for that free finance assessment at 877-600-2487, 877-600-2487.